program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Thanks for joining us here at AusBiz. Let's get across what we saw overnight. Global equity markets mostly higher, while the US dollar weakened further. Over on Wall Street, investors were somewhat cautious amid rising treasury yields and a fall in US jobless claims. This comes, of course, ahead of the Fed meeting next week. Now, stocks specifically, Meta rose after reports said the tech giant planned cuts of up to 30% of its metaverse budget. Meta has committed as much as $72 billion in capital spending this year. Amazon shares came under selling pressure after it said it was in discussions with the US Postal Service as it considers its options before its contract expires next year. Intel was among the worst performing stocks, while Salesforce rose after it raised its fiscal 26 revenue and adjusted profit forecasts. Snowflake fell heavily after the cloud data analytics company's fourth quarter product revenue forecast was below investor expectations for stronger growth. The consumer staples sector was dragged lower by falling Kroger, with the supermarket chain narrowing its annual sales forecast and missing quarterly sales estimates. Hormel Foods climbed after the peanut butter maker forecast annual profit above estimates, while Dollar General shares surged after the discount retailer raised its annual profit forecast. At Paramount, Skydance fell, with Netflix leading the bidding for Warner Brothers Discovery. Shares of the copper miners fell, tracking lower prices of the red metal, which did hit a record in the previous session. Well, the number of Americans filing unemployment benefits fell to a more than 3-year low last week, which has helped allay fears of a sharp deterioration in labour market conditions. An independent survey found the economy lost 9,000 jobs in November, which follows a read on private payrolls, which decreased last month by the most in more than 2.5 years. And new orders for US factory goods increased less than expected in September, as manufacturers remain constrained by tariffs. Factory orders rising 0.2% after a downwardly revised 1.3% increase in August. US Treasury yields have risen as investors consolidate positions ahead of next week's Fed meeting, with the central bank widely expected to deliver a third consecutive rate cut. And the US 2-year Treasury yield was up to 3.53%, the 10-year closed to 4.1%. The US dollar has fallen further against the yen, which is heading for its largest weekly gain against the greenback in more than 2 months. The yen has been boosted on reports that the Bank of Japan is likely to raise interest rates this month. The Aussie trading at 66.1 US cents. On the commodities front, oil prices have risen on expectations of a US rate cut, while the stalled UK peace talks has tempered expectations of a deal restoring Russian oil flows. Brent crude up around 1% to $63 a barrel. Copper prices have eased slightly after hitting a record, while iron ore is down around 0.5% at 106 a tonne, and gold largely unchanged as rising US Treasury yields offset support from a weaker dollar. Spot gold trading at around 4,200 US an ounce, and Bitcoin is trading above 92,000 US dollars. All right, let's get across what we're seeing on markets with a focus on the US. Dave Sekera is the Chief US Market Strategist at Morningstar. He joins us again. Dave, welcome back for our monthly catch-up. This is the last of the year, so interested to know how you would characterise where we've been over the course of 2025. And, well, I guess at the moment, as I mentioned there, investors somewhat in a holding pattern ahead of that Fed meeting next week.
I mean, it certainly had been a volatile year at the beginning of the year with the Liberation Day tariffs, DeepSeek hitting the headlines. The U.S. markets were down about 20%, before they hit the bottom. In fact, we actually had moved to an overweight recommendation. I think it was on the April 7th edition of my podcast, The Morning Filter. And then once we started moving up in the middle of the year, up towards fair value, went back towards, that market weight position, which is where we are still today. As I look for, the rest of the year as we're heading into the holidays, it looks to me like 2025 is really kind of winding down on a pretty stable note here in the US. Overall, pretty strong stock return thus far this year. The Morningstar US Market Index, that's up about 17.5%, and that follows 2 years of over 20% return. So with holiday sales off to a pretty solid start, yes, there are some signs of buyer exhaustion in AI stocks. Stocks like Oracle, have given up a lot of their gains. Some of them are still a little overvalued, maybe a little overextended, like ARM. I think Intel has probably rebounded too much, but a lot of the really big mega cap names, our analyst team still sees a lot of value in Nvidia, AMD, Microsoft, Amazon. So are we looking for, that seasonal Santa Claus rally this year as we go into the holidays? I'd say barring any exogenous catalysts, I think that's more likely than not. Right now, I think the market in the U.S. wants to just do more than anything else, just to lock it in and wind down the year, lock in these returns, and really then start looking forward to 2026.
Do you think Santa Claus is likely to deliver this year, Dave?
Yeah, I think that's more likely than not. So, we'll see what happens. I think, as long as there's really no major exogenous catalyst, that's hitting the headlines, I think people are really just, already kind of put in the positions that they want to be in to, have their portfolios for their 1231 reports. So I don't see any big major changes, coming over the next couple of weeks.
Let's take a look at your price to fair value, your style box there. We'll bring that up and just talk us through then where we're at right now.
Yeah, so just as a reminder, we do look at valuation for the market, I think a little bit differently than you'll hear from a lot of other market strategists. We cover over 1,600 companies globally, of which over 700 trade on U.S. stock exchanges. And what we do is we do a bottom-up analysis. We take the fair value estimates of all of those companies on an intrinsic value-weighted basis, and we compare that to the combined market capitalization of all of those same companies. And that's what this, price to fair value calculation is. So, at the end of November, the market was trading at about a 3% discount to a composite of our fair values. We then break that down into the Morningstar style box. So if you look at it by category or by style, you'd note that both value stocks and growth stocks, both trading at slight discounts right now. Value trading at about a 6% discount, growth stocks at a 7% discount, whereas core stocks trading just a little bit above fair value right now. So I think it's probably a good barbell position right now to be overweight value, overweight growth, and maybe underweight core in order to pay for those positions. But really, it's still the most undervalued part of the market. I think we've been talking about this all year. Really, that small cap space. Now, for the most part of this year, we have cautioned investors that I really didn't necessarily expect small cap stocks to really outperform this year. Just the reasoning behind that is small cap stocks typically do best when the Fed is easing monetary policy, long-term interest rates are coming down, and the rate of economic, growth in the U.S. is bottoming out and starting to reaccelerate. We really hadn't had all of those conditions line up just yet, but looking forward to 2026, by the middle of next year, we do think that will line up. So we are looking for the Fed, to cut interest rates at least, several times by the middle part of next year. We look for long-term interest rates in the U.S. to come down, for the 10-year U.S. Treasury to come down towards like 3.5%. And even though we are looking for the rate of economic growth to slow the next couple of quarters, we're looking for the easing monetary policy to start bolstering the economy in the U.S. in the second half of next year. So I think investors at this point should be well positioned in that small cap space to be able to take advantage of that.
Dave, let's break this down into sector valuations, beginning with those sectors you're seeing as undervalued at the moment.
Yeah, real estate still the most undervalued, trading at a 10% discount to fair value. And I'd say it's pretty broadly undervalued across the entire sector. About 2/3 of our coverage are rated 4 or 5 stars, meaning that we think those stocks are anywhere from undervalued to significantly undervalued. And I think you're going to get a good tailwind from that easing monetary policy and declining interest rates, in real estate next year. Now, personally, I still prefer real estate with much more defensive-oriented characteristics, whether it's research and development, healthcare, wireless towers, or retail. And I'd probably still steer clear of urban office space. I still think that's oversupplied at this point. So a couple of the names in the U.S. that we have been advocating for have been Healthpeak Properties, which is a healthcare REIT. That's a 5-star rated stock, 37% discount to fair value. very high dividend yield at 7%. Among the wireless providers, the wireless towers, we like Crown Castle. That's a 4-star rated stock at a 30% discount, almost a 5% dividend yield. And then in the retail space, I'd highlight Realty Income. It's a triple net lease provider, 5-star rated stock at a 30% discount, 5.6% dividend yield.
I'm interested to get your view there of tech and why you think some of those stocks are undervalued at the moment.
Yeah, we had a lot of big fair value increases after the third quarter earnings, across the entire tech space. So it's really a combination of, a number of those AI stocks that had gotten a little overextended by the middle of the year, did sell off, so that brought those valuations down. Whereas companies like NVIDIA and AMD, we brought our valuations up even further as we updated our models, with new information. At this point, NVIDIA is a 4-star rated stock, trading at a 24% discount to our $240 fair value. AMD, we have long thought was always going to be kind of the number 2 player in the semiconductor GPU space for artificial intelligence. That's at a 20% discount, puts that in 4-star territory. And we've been constructive on Microsoft, all year long. It's a 4-star rated stock at a 20% discount. Company just continues to keep hitting, on all cylinders. So those are the ones from the AI perspective, from more of like the hardware space that we're behind today. But I do think next year in 2026, I think the market will start to turn its attention away from a lot of the hardware providers. I think that story is really getting to be pretty played out at this point. And looking for those companies that will be able to leverage AI in their own products, be able to increase economic value of their own services, be able to incorporate it in their own business practices to be able to generate, more efficiencies in order to gain operating margin expansion. A couple companies we've been highlighting all year that for the most part, these stocks haven't really done all that much, but I think that they're probably in a position with, where they are now that they should start to perform. So Salesforce, that's a 4-star rated stock that was trading at about a 24% discount. They just reported good numbers. In fact, I think that's about the third quarter in a row that they've really beat expectations. We're starting to see the market start to appreciate that stock. 2 others I'd highlight are ServiceNow and Workday, both 4-star rated stocks. And then lastly, I find a lot of value in the cybersecurity space. Our favorite there right now is Palo Alto. That's a 4-star rated stock at a 14% discount.
Dave, always terrific to get your analysis from Morningstar. Thanks so much for that, and enjoy your festive break. We look forward to speaking with you in the new year.
You too as well. Thank you very much. Cheers.
Okay, let's return then to the local market. On this Friday, we're expecting a marginally higher open. SPI futures up just 6 points. And we'll get across that. What else is moving with a couple of AGMs to get across as well today. Join us in just a couple of minutes' time.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.